Friends, in this session, we would be talking on analysis of financial statement, especially after the enactment of the Indian Companies Act 2013. So, the present stage, that is the emerging situation, uh, emerging in the emerging situation, it is essential for a lending banker to look for more information in addition to what is the antecedents of the borrower. And financial aspect is one of the important area the lender has to look into before taking decision on a loan proposal. How it can be created, and for that, the lender has to refer to various data, various information that is thrown up by the organization, by the enterprise, frequently, so that he can have an access to this information. And an in-depth study of the knowledge, in-depth study of the financial position, or in-depth study of the financial statements reveal that how best the business is, how whether it indicates that whether the business is financially sound enough, and whether bank can extend finance towards this unit. So what is actually financial analysis? So the financial analysis, in the nutshell, we can say that it is a breaking down of complex set of facts and figures into simpler items. That is financial statement, analysis of the financial statement. Then what is interpretation? Interpretation is the critically examining these simpler items for a logical conclusion or for taking proper decision at the appropriate level. Okay. Now, what are the financial statements frequently as a lender we come across? One of the important statements is that balance sheet. That is balance sheet as per the Companies Act 2013. That we can say that Schedule 3 of the Companies Act 2013, Schedule 3. Then auditor's report, that is forming part of the balance sheet. Then board of directors report wherever occurred. The second important is the statement. We can say that statement of profit and loss, SPL, the statement of profit and loss as per the Schedule 3 of the Indian Companies Act. The balance sheet as per the Schedule 3, then statement of profit and loss as per Schedule 3. Then cash flow statement, that is important as per Accounting Standard 3. Statement of subsidiaries, associate joint ventures, that is also required, that is also taken care, that also be examined by the lending banker when we go for the analysis of the financial statement. Then statement of changes in equity wherever is applicable. So these are the important statements which a lender has to go through at the time of processing a loan application. When we talk about balance sheet, what is balance sheet? Balance sheet can be said, or balance sheet, we can say that the statement of the financial position, which reveals the money value of company's assets, liabilities, and owner's equity. Owner's equity means net worth on a particular date is known as the balance sheet. Balance sheet, which I repeat, that the statement of financial position which reveals the money value of company's assets, liabilities, and owner's equity, that is net worth, on a particular date is a balance sheet. Is the balance sheet. Particular date is a 31st March or 31st December or 30th September or 30th June. Like that, the particular date. What is actually, it is not that the cumulative position. It is a position as on the particular date only. Then what is profit and loss? Profit and loss, on the other hand, is a statement of performance of the firm over the years ending with the balance sheet date. Pura, 1 year, aggregate operating, there is a statement of performance during the year is taken care in the profit and loss. Whereas balance sheet as on a particular date only. There is a difference between these two. Then what some legal precautions, legal position is there so far as balance sheet and profit and loss. So balance sheet as per the Companies Act 1956, it says that it should be financial statements should present a fair and present a true and fair view of the state of affairs of the enterprise or the affairs of the company. That is, financial statement should present the true and fair view of the state of affairs of the company. That is as per the Schedule 6 of Indian Companies Act 1956. Then the items contained in such financial statements should be in accordance with the accounting standard. Accounting standard, it should be in strictly as per the statements shall be strictly as per the accounting standards. Then, so far as profit and loss is concerned, that is SPL we can call it as, must show the in specific information as required by Schedule 4. Schedule 4 of the Indian Companies Act 1956. Now, Indian Companies Act, when we go through that balance sheet, there are liability side, there are 5 items. That is, one is that cash share capital, then reserves and surpluses. Frequently you are going through this balance sheet. The share capital one, then reserves and surpluses, then comes secured creditors, then unsecured creditors, and current liabilities and provisions. These are the 5 items, broad items, which are coming as per the in the liability side as per the balance sheet 2000 balance sheet 1956. 1956. Okay. And asset side, when we take, that is fixed asset one side. Then comes investment. There is long-term investments. That is a non-current assets. Investment, non-current asset, other than current assets. Non-current asset. Then comes current asset. Then loans and advances, which are partly, it may be current asset also. It may be non-current asset also. Then miscellaneous expenditure, or we can call it as intangible asset, intangible and fictitious assets. These are the items which were included in the balance sheet as per the Companies Act 1956. Now the act this format has undergone change as per the Companies Act 2013, which is now in force. But both the acts are being taken care. It is not that we should go as per the 13 only. No, in many cases it is lenders are going as per the Companies Act 1956 also. So as per the Companies Act 2013, the format has changed. The broadly it is classified as that equity and liabilities. Equity liabilities, the main item is shareholders funds, then share application money, pending allotment. These are the 2 items coming. In shareholders fund also, there is coming share capital will come, then reserve and surpluses, the money received against share warrants. These are the 3 items coming under the this one share capital and shareholders funds. As per the, now we are talking as per the Companies Act 2013. Now, second one is, as I told you, then share application money pending allotment. Then third, non-current liabilities. Broadly, that division is that equity, other than equity, that is non-current liabilities and current liabilities. These are 2 broad categories. Non-current liabilities, there are various items coming. That is all long-term borrowings, other long-term liabilities, long-term borrowing, other liabilities, deferred tax liabilities, there is a net position, deferred tax liabilities and deferred tax asset. The net position is shown here, the net current liabilities. Then that is other long-term liabilities. These all the 3 items are classified under the non-current asset, non-current liabilities. Then current liabilities all will comes that short-term borrowings from the bank, then trade sundry creditors, trade payables, then other current liabilities, short-term provisions, whatever the unit has made, those things. So these are the items which are coming in the liability side so far as the balance sheet as per the Schedule 3 of the Indian Companies Act 2013. Now coming to asset side. Asset side also broadly classified into two sections. That is current asset, that is a non-current asset and current asset. Non-current asset, it is inclusive of fixed asset, tangible asset. Tangible assets means fixed asset, whatever items coming, that is a plant and machinery, land and building like that. Then intangible asset, it is inclusive of the fixed assets also. Then capital work in progress. Then second category, non-current investments. It's a part of the non-current liabilities also. That is non-current investment. That is, as I told you, investments which are realizable after 12 months, after 6 months. That is taken care here. Then another item is deferred tax asset. Deferred tax asset, it is an intangible asset. That is also taken care here under the non-current asset. Then long-term loans and advances, which would be receivable after the prescribed period. Then other non-current asset. These are the items which are coming under the non-current assets. Because asset side, as I told you, there are broadly two categories: non-current assets and current asset. The current asset, as you know very well, they are current investments, that is within 6 months period, realizable within 6 months. Then inventories, then trade receivables, that is debtors. Then cash and bank equivalents, short-term loans and advances, other current assets, prepaid expense or like that, whatever is given, whatever payments made, including tax paid, provisions paid, TDS deducted, all the items will come other current asset. So the total will be there. So in nutshell, we can say that liability side, broadly equity and liabilities, their share capital and other things will come. Then non-current liabilities and current liabilities and provisions. That is liability side. Then asset side, when we talk non-current assets, then comes second one is current asset. These are the broad line. Whereas in the 1956 balance sheet, liability side we have seen there are 5 broad categories. The share capital, reserves and surpluses. You remember, reserves and surpluses. Then secured creditors, unsecured creditors, then current liabilities and provisions. Similarly, in the asset side also, asset side, fixed asset, the investment, that is a non-current asset, then current asset. Then comes finally the loans and advances and intangible assets or miscellaneous expenditure. These are the items which are in the, as per the Companies Act 1956, whereas here broad classification is different. Non-current liabilities, current liabilities. Then equity and surplus, equity and liabilities, that is a liability side, and current asset, that is non-current asset and current asset. These are about the balance sheet. How they can analyze the balance sheet. What are purposes of analyzing this one? As a lender, purposes are different, and other ordinary people, purposes are different. See, the users, we can say that users other than lenders or other than bankers, they can, because many cases, people are going through the balance sheet of the business concern just to take the economic decision, to making economic decisions. Economic decision in the sense what to do, whether to go in for further investment, any investment decision taken, or any investment in deposit and other thing, or any convertible debentures and other thing. So such economic decisions, and as a unit as a whole also, an economic point of view, they would be, the decision can be taken by analyzing, while going through the balance sheet. That is other than the banker. Then, so for if you take a stock market investor, yes, he is concerned with he or she is the investor is concerned with what? EPS, earning per share. That is what he always looks. The person always looks at the financial statements to what is the EPS, what is the movement, what is the trend. Based on that, he can take that take a call or make the proper investments. Then statutory authorities, they will see that the provisions have properly been made and statutory compliance, other statutory complaints are taking complaints are taking place as required by the units concerned. These are the purposes other than these bankers. Okay. So far as a banker is concerned, we are the bankers. Banker is concerned first, assessment of the past and present performance. Assessment of the past performance and current position, so that the banker can take a decision. Past performance, what will give, what is the performance, and based on which, whether the unit is in a position to perform in the same line or better than this one, or any deterioration in the performance that has taken place in the previous period. That is one thing. Second, detecting, that is important so far as credit decisions are also taken. Bankers, every time we are going as per the projections. Limits are being sanctioned, credit limits are being sanctioned based on the projected means projections, we can say that. So even RBI also emphasized that reasonableness of the projections very important. Reasonableness of the projections, we mean whether whatever projected, whether the unit is in a position to achieve, or they can. That is because what is a logic behind their, that we should also see what is the logic behind in their projections. The logic, how we can get it, that is only by analyzing the past trend. Many times your lenders will go through 2 years, or some bankers will go through 3 years performance, so that they can come to the conclusion. Yes, what is the trend? What was the performance? And based on that, what will be the performance? Whether the unit, whether the industry, whether the activity of the unit is able to achieve, whether it is reasonable or not. And the reasonableness is the basic thing based on which the limits are being considered, or credit facilities are being considered by the lending institutions. That is one. Second, prediction of the net income and growth prospects. What is the profit? What was the net profit? What was the gross profit? What are the items included in there? Other than operating profit, what are the other items included? And these analysis, they will give this a basis. So based on that, their projections, growth project, whether the unit, whether the particular borrower, proponent, whether he is able to achieve the projected net worth, projected gross profit. These things can be analyzed, and based on the bank lenders can take the call. So there is prediction net income, because the lender has to take the satisfy that these projections are reasonable, and accordingly he can take a decision. He can come to the conclusion that future prospects are bright or reasonable, so this unit can do better, and they can achieve the targets fixed. Then detection of danger signals. These financial statements will give, there is a direction in which the business is going, because we have discussed in the frauds and other things. So the financial statement itself will show whether the industry is doing well, whether the unit is doing well, whether it is any overtrading is taking place, whether any diversion is taking place, whether any siphoning is taking place. All the things from these financial statements only the lender can come to know, means the banker can come to know. There is a danger signal, and even existing units also. By analyzing the account also another area, accounts, then financial statements. Both the things, close study, for close examination will always give any danger signals are there. Because for that purpose, these early warning signals are there. RBI is issuing to frequently, means time to time, and those things are there. Vis-a-vis the financial statement indicators. All the things compared together, then they will come to the conclusion that any danger, means because we have to take steps, preventive measures, or prevention, as I told you, is better than always cure. So this is another area which can be examined by a lending banker by going through the financial statements. Now, prediction of bankruptcy and failure. That also, if industry is not doing well, some external or internal problems are taking place or brewing. So based on that, what is going to happen to this particular unit, which we are already financed or which we are going to finance? All these things, whether the unit may end up in bankruptcy or any failure will be there, we have to take care of our money back. So for that, we have to ensure that no such calamities or incidents would take place in the near future, and accordingly, the lender can go ahead with the proposition. Then loan decision, as I told you, this is one of the this is the most important tool for taking a call, taking a decision whether the lender can, first of all, whether the lender can see whether the unit is financially sound enough and whether he can finance in the unit. So those things can be seen by analyzing or examining the financial statement thoroughly, and the banker can come to the conclusion. Examine fund flow. Another area is fund flow. Fund flow in the sense, the fund which we have parted with, the funds bank has already disbursed, whether the purpose for which it was disbursed or purpose for which it was meant has been met or not. Because any diversion, suppose this money has been utilized for acquiring some fixed asset, then that means a diversion. Fixed assets which are needed for the unit, then it is a diversion. For any unrelated activity, then it will lead to siphoning of the fund, which is a criminal offense. So these things can be seen by fund flow statement. And how fund flow, suppose unit has not submitted the fund flow statement, a lender can also do prepare the fund flow statement by taking 2 years balance sheet, and based on that, the balance sheet, based on that, this lender can very well work out what are the long-term sources from where the money has come, what are the long-term users, what are the long-term short-term sources, what are the short-term users, and always see that long-term sources, part of the long-term sources should be utilized for the short-term users. That means there must be their net working capital. It's in working capital. Net working capital is whatever the excess long-term funds over long-term users, that is known as the net working capital. So working funds are brought in from long-term sources, and other way around, suppose any short-term funds are utilized for the long-term users, that means a diversion. That is, long-term funds are not supposed to utilize or not supposed to use for long-term users. That means a diversion taking place, or is siphoning taking place. These things can be checked. These things can be examined, analyzed by going through the fund flow statement, which if it is not ready, it can be prepared by the lender himself, and we can cross-check it. We can verify it. Then cross-checking. Cross-checking is another area. Because statements, financial statement, stock statement, booklet statement, everything submitted as on the last day of the month. Then suppose March it is submitted, but the balance sheet and other things prepared later on only. So we will have to have a cross check whether what is shown in the balance sheet is tallying at least near to what is it is tallying with the what is shown in the what is stock statement. That way we can go it. So these are the areas where these are the purposes for which these financial statements are used. So we have discussed about the Companies Act 1956, what is a balance sheet. Then comes, as per the Companies Act 2013 also, what are the areas to be covered, we already discussed. Then in detail, further, that is rearrangement and other thing, we would be discussing, we will be talking in the next part 2, we will be taking care of, okay.